The athleisure industry is no longer a growth story. It is a margin war. A $440 billion battlefield where brands are not competing on products alone, but on pricing power, identity, and operational survival. Nike leads through global scale and culture. Lululemon leads through margin efficiency and lifestyle dominance. And Under Armour is in the middle of a structural reset, trying to rebuild its identity before being permanently outpaced. But the real question is no longer who is growing. It is who can survive the margin compression defining this industry. In this analysis, we break down the external forces shaping the industry, the strategic positioning of each player, and why Under Armour's sports house pivot may determine whether it becomes a comeback story or a cautionary tale. The athletic apparel industry is structurally split. On one side, performance utility. On the other side, it's about lifestyle identity. Brands are no longer selling apparel. Rather, they are selling belonging, identity, and aspiration. This shift defines the $440 billion opportunity, but also intensifies competition, pricing pressure, and brand dilution risk. In the PESTLE analysis, political forces are increasing cost pressure across the industry. Tariffs from Donald Trump continue to raise production costs in key hubs like Vietnam and China, forcing brands to either absorb margin losses or increase prices. The ongoing US-China tensions are also pushing costly supply chain shifts. However, policies like the USMCA and the Fabric Act create opportunities for nearshoring, and at the same time, stricter regulations such as the Uyghur Forced Labor Prevention Act increase compliance costs and reputational risks. Economic conditions are also tightening demand. Because inflation is reducing discretionary spending, it makes consumers more price sensitive. This is a challenge for Under Armour, which sits in the premium tier but lacks the financial strength of Nike. Meanwhile, rising input and logistic costs are squeezing margins. On the positive side though, growth in e-commerce and direct-to-consumer channels give Under Armour a chance to improve margins and strengthen customer relationships. Yet, competition is intensifying with fast-growing challengers like VRIO. Consumer trends are expanding demand, but shifting preferences. Increased health and fitness participation supports Under Armour's performance identity. However, the rise of hybrid work and everyday athleisure favors lifestyle brands like Lululemon Athletica, which puts Under Armour at a disadvantage. Social media platforms like Instagram and TikTok also play a major role, offering cost-effective marketing opportunities. And at the same time, growing demand for inclusivity and women's apparel highlights a key gap for the brand. Technology is driving innovation and competition. Smart apparel and wearable integration, led by companies like Apple, are emerging trends, but require heavy R&D investment. Under Armour remains strong in fabric innovation, especially in moisture-wickening performance. Additionally, AI and digital platforms offer opportunities to personalize customer experiences and improve operations. Sustainable technologies like 3D knitting are also becoming increasingly important. Legal pressures also rise costs among labor, IP, and sustainability. Stricter labor enforcement from agencies like the US Department of Labor increases compliance costs, and at the same time, stronger IP protection helps defend innovation. However, new environmental laws and ESG disclosure requirements from the US SEC add reporting burdens and operational complexity. Sustainability is now a baseline expectation. Consumers increasingly demand recycled materials and ethical production. Resale platforms like Poshmark and Depop are extending product life cycles and influencing buying behavior. At the same time, certifications such as the Blue Sign are becoming essential to avoid greenwashing concerns. Environmental risks like plastic pollution may also lead to stricter regulations in the future. The overall insight in the PESTLE is that external forces are compressing margins all across players. Moving on to the Porter's 5 forces, the structure of the industry explains why margins are actually under pressure. First, buyer power is high. consumers can switch brands instantly due to price transparency and the rise of dupes or duplicates. Second, supplier power is low because materials are commoditized and supply chains are fragmented. Number 3, threat of new entrants is high, driven by e-commerce and influencer-led brands. Number 4, the threat to substitutes is also high, with fast fashion and casual wear replacing athleisure in many use cases. And lastly, competitive rivalry is extreme. Overproduction leads to constant discounting, which erodes brand value. And the conclusion here is simple, that this industry, where profitability is structurally difficult to sustain, is a fact. Now, if we map the industry based on brand premium and global reach, 3 strategic archetypes define the market. First, Nike is the scale dominator, which shapes global sport culture through unmatched distribution, athlete ecosystem, and storytelling power. Lululemon is the margin leader, transforming athleisure into a premium lifestyle system with industry-leading profitability driven by DTC and community loyalty. And finally, Under Armour is the performance challenger, which currently rebuilds its foundation through its sports house pivot. This quote-unquote middle position is quite dangerous as it lacks both scale advantage and premium dominance. Therefore, Under Armour's strategy is to move upward with premium positioning and outward with global expansion. Early margin improvements suggest that this shift is actually beginning to work. Now, in the key success factors, we have to survive the margin war, and there are 5 factors that are critical in this discussion. First, the direct-to-consumer control has to protect margins and pricing power. Second, lifestyle integration, which expands usage beyond the gym. Third, proprietary performance technology, which needs us to create switching costs. Fourth, inventory discipline, where we need to avoid discount-driven brand erosion. And fifth is authentic community building, which is especially important with the rise of Gen Zs. These are not competitive advantages. Rather, they are survival requirements for Under Armour in the long term.
Nike shows strong advantages built on brand and innovation through its scale and supply chain for global reach while achieving competitive parity. Its edge comes from IP and digital ecosystem. Nike's brand equity, the swoosh, was built over time. Yet, execution gaps in aligning innovation, digital, and retail remain. Nike is advantage-rich but sometimes misaligned. Lululemon is focused, differentiated, and experience-driven, and its strengths include proprietary fabrics and a strong DTC retail network, and these support premium pricing and product quality, which creates an advantage, though not inimitable. Their differentiation comes from its intangible assets, a wellness-driven brand, community ambassadors, and a strong in-store experience that build deep customer loyalty. Yet scaling these globally create execution challenges. It is highly focused with strong but scale-sensitive advantages.
In our value chain analysis, we need to understand the competitive standing of Under Armour relative to Nike and Lululemon Athletica, and thus, we conducted a comparative analysis of the value chain to identify where the advantages are sustained and where gaps exist. Starting with the support activities, we see a clear difference in strategic focus. UA is in restructuring mode, led by CEO Kevin, simplifying operations to regain efficiency. Nike operates with a centralized global structure, enabling scale and consistency. And Lululemon is focused on agile leadership expansion, particularly in high-growth regions like China. In human resources, the contrast is scale versus specialization. Nike leverages a massive workforce and its employee-athlete culture. Lululemon emphasizes diverse leadership and community alignment. And Under Armour remains leaner, but it is still aligning its workforce with its new performance-focused direction. Now, in technology development, all 3 differentiate, but in different ways as well. Nike leads with large-scale innovation platforms like Air and Zoom. Lululemon focuses on comfort-driven fabric innovation, or its science of feel. But Under Armour invests in performance-based technologies like heat gear and cold gear, but at a smaller R&D scale.
Across these brands, procurement uses standard and specialized materials. UA and Nike rely on common inputs like rubber and foam, resulting in competitive parity. Lululemon differentiates through proprietary fabrics and sustainable sourcing practices. So overall, procurement is essential but mostly standardized, with Lululemon showing greater differentiation. These companies rely on global suppliers and third-party logistics. Nike uses internal sourcing and RFID tracking, while UA depends more on contractors, and Lululemon partners with providers like DSV. Thus, inbound logistics are advanced but standardized, leading to competitive parity.
Looking at operations, the gap becomes more structural. Nike dominates with a highly optimized global supply chain. Lululemon operates an efficient DTC integrated ecosystem, but Under Armour is still streamlining, reducing SKUs and simplifying its supply chain to eliminate inefficiencies.
They also use global distribution networks and third-party logistics. Nike leads with advanced omnichannel systems and partners like DHL and FedEx, while UA and Lululemon operate multiple distribution centers. Thus, outbound logistics are efficient but standardized, which leads to competitive parity.
In market and sales, the positioning is very clear. Nike wins through global scale and athlete dominance. Lululemon wins through community and lifestyle branding. But Under Armour is shifting from discount-driven messaging to more performance-focused storytelling. Now finally, in service and customer engagement, Nike leads with a powerful digital ecosystem. Lululemon builds loyalty through community programs and resale initiatives. But Under Armour is growing its ecosystem through its UA rewards and digital platforms, but still trails in engagement depth. The overall insight is as follows. Nike dominates through scale efficiency, Lululemon dominates through margin-focused integration, but Under Armour is still rebuilding its value chain, moving from a fragmented, volume-driven system to a more disciplined, margin-focused model. And in a $440 billion margin war, this transformation is not optional. It is critical for survival. In terms of current strategy, Nike follows a differentiation at scale, Lululemon follows focused differentiation, and Under Armour is executing a turnaround strategy. Geographically, these firms are at a very different stage. Nike is a global powerhouse, but its scale is now a constraint, with softness in key markets like China and North America forcing a reset. Under Armour is highly concentrated in North America, making it vulnerable. While it is seeing early traction in EMEA, it is essentially rebuilding while it's still operating. And Lululemon Athletica is the most aggressive growth in terms of its story, rapidly expanding in China and capturing untapped international demand.
Under Armour is driven by apparel, with footwear as its key growth area. Nike is more diversified, led by footwear but supported with apparel and equipment across all sports and lifestyles. Meanwhile, Lululemon is highly apparel-focused, particularly in premium athletic and everyday wear. Overall, all of these three compete in similar categories, but their focus and depth differ, shaping their strategic positioning.
Strategically, all three are moving, but in different ways. Under Armour is in full reset mode, cutting SKUs and refocusing on performance to rebuild margins. Nike is also resetting by correcting its overextension in DTC and rebalancing its channels. Lululemon, however, is executing consistently, scaling its model through global expansion and new categories. At the functional level, the contrast is clear. Nike wins through scale and marketing dominance. Lululemon wins through community and premium brand control. And Under Armour is still restructuring, simplifying operations, strengthening its supply chain, and doubling down on performance innovation.
Each brand uses a different marketing approach. UA is shifting to product-led storytelling in athletes and digital channels. Nike focuses on massive global reach by spending billions on endorsements. Meanwhile, Lululemon emphasizes grassroots marketing through local ambassadors and community engagement. They fully outsourced manufacturing across multiple countries like Vietnam and Indonesia with ongoing diversification. Nike has extensive global outsourced supply chain with hundreds of factories across Asia through Vietnam and China. And Lululemon fully outsourced production to multiple vendors across Asia as well, but with flexible and limited long-term contracts. It has its distribution strategy, with UA streamlining operations, focusing on key US hubs and third-party logistics for international markets. Nike operates a dual-channel model by combining DTC and wholesale, supported by global distribution networks. And Lululemon is expanding its reach across key markets in the US, Canada, and Australia with new distribution centers and continued use of third-party partners. Innovation and R&D, UA focuses on performance technologies that they already have, though its fabric innovation is more limited. Nike leads with advanced research in biomechanics and materials by driving innovations that they also have. Meanwhile, Lululemon emphasizes proprietary fabrics, protecting its innovations through supplier partnerships and branding than owning production. Workforce focuses on inclusion, pay equity, and employee engagement. Nike follows a culture-driven, sports-focused values supported by various employee programs. And Lululemon also practices employee inclusion, pay equity, and highly desirable labor benefits. UA is refocusing on a premium e-commerce experience and loyalty programs after divesting MapMyFitness. Nike leads with a strong digital ecosystem to its apps. Meanwhile, Lululemon expands through e-commerce, mobile, and platforms supported by omnichannel integration. Here's the bottom line. Nike is correcting its scale, Under Armour is correcting its structure, and Lululemon is scaling its advantage. And in a margin-driven industry, execution, not strategy alone, will determine who actually survives. From a financial perspective, the contrast between these companies is very clear. In terms of scale, Nike dominates. Its revenue is multiple times larger than both competitors. But that scale comes with complexity, which puts pressure on margins. UA, on the other hand, is in a revenue right-sizing phase, intentionally shrinking sales by cutting low-margin channels. But when you look at profitability, Lululemon is the clear leader. Its high gross and operating margins reflect a highly efficient DTC model with strong pricing power. UA's gross margin is actually very strong, in fact, even higher than Nike's, proving its products have premium value. However, its cost structure is the problem. The high operating expenses turning profit into losses. In terms of liquidity, all three companies are stable, meaning Under Armour has enough resources to sustain its turnaround. But when you look at returns, the gap becomes clear. Nike and Lululemon generate strong shareholder returns, while Under Armour's negative ROE reflects the cost of restructuring. Here's the bottom line. Nike is the stability play, Lululemon is the efficiency leader, and Under Armour is an asset-heavy turnaround. And in a margin war, success for Under Armour depends on one thing. That is, aligning its cost structure with the premium value its products already deliver. Critiquing Nike, they are strong as a market leader with around $46 billion in revenue and a strong R&D driving innovations like Air and Flyknit, with renewed focus on sport-led strategy under Elite Hill. But the weakness comes as their revenue declined by 10%, with over-reliance on legacy products have led to markdown pressure, with supply chain concentration in Vietnam and Indonesia adding risk. Now, critiquing Lululemon, they are strong with high margins from its DTC model, strong growth in China, and a community-driven brand through ambassadors and store educators. But the weakness lies on their heavy reliance on the Americas, which comprise 75% of the revenue, limited wholesale reach, and past quality issues that expose scaling challenges. Under Armour's biggest challenge is being stuck in the middle. It lacks Nike's scale advantage and Lululemon's premium dominance. Its turnaround strategy is actually directionally correct, but it poses high risks because it depends on three things. 1. The success of premium positioning. 2. Disciplined cost control. And 3. The expansion beyond North America. And thus, the final insight is as follows. In a $440 billion margin war, survival will not be determined by growth alone. but by the ability to protect pricing power while everything becomes commoditized.
This has been Fantastic 5. Thank you